Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Paris and talk with John Najarian of OptionMonster.com. John Najarian, for those who don't know, what is option trading? What role does it play in the overall markets? And welcome to the Keiser Report.
First of all, Max, delight to be here. Enjoyed your reports for years, and now I get to actually be on with you, so I'm flattered. What role does it play? Options, of course, are a derivative that lets people use leverage in their favor, or unfortunately for some people, use it like fire and they burn themselves. But overall, options trading, in particular in the U.S., has really exploded lately. And I think some of that, Max, is because of stocks like Apple and Google and Amazon that are so expensive to trade, people can take just a much smaller piece of that by trading with options. And now they have options that not only expire on a monthly or quarterly basis, but weekly basis. And that has also really sparked a lot of enthusiasm and interest in the product.
Well, I had actually no idea. You know, I was a big options trader at Shearson during the 80s. I was their third or fourth biggest options producer in the entire 10,000 broker system. And that's amazing that now they have weekly options, and I guess I understand tied to these very high-priced stocks like the Google stock and the multi-hundreds. You can't really buy shares of these stocks. You're forced to buy options. And just to reiterate, an option is kind of a bet on which way a stock is going up or down. Now, the Guardian newspaper in London has recently wrote that the Black-Scholes equation was the mathematical justification for the trading that plunged the world's banks into catastrophe. In particular, it says, quote, "It was the Black-Scholes equation that opened up the world of derivatives." Okay, so, John, going back to the late 70s and early 80s, tell us about the Black-Scholes option pricing volatility formula.
Sure. Well, basically, folks, since, as Max said, an option can give you the right to buy something or the right to sell something. So a call option is the right to buy something. People try to figure out what is that option on buying Apple at $650 a share worth. So they basically plug it into a formula. The Black-Scholes model is the one Max is talking about, but there are 5 or 6 others that people developed over the last few years. And it's a formula that basically calculates along a bell-shaped curve and figures out the possibilities of various outcomes. And that there are knowns, of course, like how much time until expiration. If it's a weekly option, there are 7 days or 2 days or even just 1 day as you get into the final days. Interest rates are pretty known. The price of the stock and the price of the option, those can move, of course, with volatility. And so that concept of volatility, Max, which you saw in 1987 explode to record levels, that is one of the key components of options. The more fear there is in the marketplace, the greater the potential movement up or down for that particular asset, and that influences the price of the option.
All right, let's talk about, for example, a stock like Google. For an example, let's say it's trading at $700 a share. Now, I think people can readily understand that if you want to make a bet that the price is going to go above $700 a share, and that bet would be based on the current price of $700 a share, and therefore you're going to pay for an option. But what people might not really readily understand is that you also have the ability to buy an option based on the price going to 105, 110, 115, and 120. So you're buying effectively an option on a theoretical price, and that's where this formula or volatility formula comes in, the Black-Scholes. This is what's so important, is because it allows the market to give a price to something that's way out of the current price. Where only volatility exists, there's no intrinsic value. Your thoughts?
Yeah, exactly, Max. And that's why a lot of people look at it as some sort of science, what we do every day in trading options, what you did for years and years at Shearson. Because if something isn't in money is known as intrinsic value, folks. So in other words, what Max described, of course, is out of the money, either out of the money bets that the stock goes a lot higher, or out of the money bets underneath the market that would be a bet that the stock is going to go down. Now, people profit very, very quickly on those panic bets to the downside. You need look no further than Apple recently, as it fell from $700 about 2 weeks ago all the way down to $620, an $80 price drop just in the last 2 weeks. That was, of course, one of those events that isn't really a known event. There was, some talk about factory closures and things like that, and maybe the mapping function didn't work so well. But basically, when that snowball gets rolling downhill, it goes down faster than, of course, it goes up. And that's why those put options, the bet that the stock price will decline, are so popular in bear markets.
All right, John, you mentioned that once the ball starts rolling, it starts to gather velocity and speed quite quickly because there are more options trading based on a company's stock than there is stock in existence. So if Apple or Google might have 100 or half a billion shares outstanding, there are 5, 10, 15, 20 times that number of shares in the options market trading in the derivatives market. So you've got this enormous leverage, don't you? But I wanted to just bring in another point quickly, which is that you mentioned out-of-the-money options. Let's talk about an out-of-the-money put option. That is a bet that the stock's going to go a lot lower, and if it's 10 or 20 bucks below the current price, you might only pay 10 cents, 20 cents, or 30 cents for that option. Talk to me what happens when a flash crash happens. And in other words, a flash crash happens, which is again caused by this extreme volatility, by the presence of this extreme leverage and these extreme derivatives. Isn't it not in the interest of somebody who has an out-of-the-money put bet to cause a flash crash? And is there, in your knowledge, John, any indication that we have instances where traders who are positioned ahead of these flash crashes are actually helping to contribute to them, to profit from them? Your thoughts?
Absolutely, Max. In fact, I've heard you rail about high-frequency trading and flash crash in your reports before, and kudos to you for doing it. High-frequency trading is one of those things that can promote or create a flash crash because all of a sudden a bunch of machines lower their bids simultaneously, and we're talking nanoseconds here, folks. And since they've taken so many people out of the market, there aren't the thousands of market makers that there used to be when Max was talking about the 80s. Gosh, Max, there were 5,000 or 6,000 option market makers on the floor in the United States. Now there are probably, I'll guess, 800 collectively across all of the exchanges in the United States that are on the floor. Now it's all just run by algorithms. So when you get a flash crash, there are certainly some people who could buy those out-of-the-money puts, betting that the market could decline, and then try to get that snowball rolling downhill very quickly by creating volatility and that fear in the marketplace, knowing that all the other algorithms will react to it by lowering their offers and lowering their bids. And since they do this virtually simultaneously in nanoseconds, you can see stocks fall very, very quickly, so that bet could pay off, and that leveraged bet could make somebody a lot of money.
Well, John, I can see we only have a few minutes left. When we're talking about options, I could go on and have this conversation last an hour or two, but let's get to some quick points here. Speaking of equations, high-frequency trading, CNBC just reported that mysterious algorithms was 4% of trading activity last week. They also said the motive for the algorithm is still unclear. So your thoughts on high-frequency trading, and is it fair to say that the motives are unclear? That seems remarkably vague.
Yeah, and it seems rather not very educated either. And clearly you and I aren't talking about it that way. I think the motives are very clear, Max. I think when somebody creates an algorithm that seems to be the intention of that algorithm to seek out bids and offers, we would call it back in the old days of futures trading, looking for stops, stop orders that are placed below the market, where somebody's looking to trigger that stop order and cause a waterfall, cause that stock or that future to roll over. I think many of these algorithms are created very much with that in mind. In other words, it's very transparent to me, not opaque, that the people creating many of these algorithms are doing so to create mayhem in the markets. I believe, of course, it should be investigated very thoroughly, but unfortunately, in many cases, the regulators are asleep at the wheel.
The Economist magazine reported a couple of months ago a report that was leaked or made visible accidentally from lawyers representing Goldman Sachs. And in this report, it said that the company was, in fact, engaged in naked short selling. That is to say that they were selling contracts that did not exist. More shares, for example, in Lehman Brothers, when Lehman Brothers collapsed, more shares were sold short than actually existed in the float. I see you kind of smiling about this. It's the first time this information went public because many people deny that naked short selling ever even existed. Your thoughts? Tell what's your thinking on this?
I've seen it for years, Max. I believe you have too. Naked short selling, folks, instead of acquiring, because when a short seller sells the stock, they have to go borrow that stock from somebody else to satisfy the delivery. Because there's supposed to be a fixed amount of stock, whether it's 100 million shares or 1 billion shares, and you're not supposed to be able to sell more than exists in the case of the stock. And in some cases, Lehman Brothers being one of those, if you had a very strong feeling that the stock was going to be going to zero, and you said, well, but it's trading at $25. If I can sell 2 billion shares worth of it at $20, when it goes to zero, I'm going to make an awful lot of money. I think that does happen, Max. I'm sorry and sad when, like I say, the regulators aren't paying enough attention, because their job is really to protect us. Whether I'm a professional trader or whether I'm investing as a casual retail investor, the regulator's job is to protect us. And when they fall down in that responsibility, their fiduciary responsibility, it hurts all of us. So the credibility of Goldman Sachs obviously is in question because of that report in The Economist. And obviously the credibility of the regulators, who should have been on top of it, should have made sure that these guys had a good borrow before they sold that much stock. That is one of the problems with the markets today.
John, we're out of time. We'll have to have you on again soon. Thanks for being on the Keiser Report.
My pleasure, Max. Thank you.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I want to thank my guest, John Najarian. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.